The future of work is here. Generac Holdings is soaring, jumping up 17.4% after massive data center demand has dramatically lifted their 2026 outlook guidance. We dive into how this surge in demand is reshaping the entire power sector and what it means for your investment strategy right now.
Never get caught with a dead phone again. This INIU portable charger is compact, travel-friendly, and gives you fast 45-watt charging with a built-in USB-C cable, so there's no need to carry extra cords. With 10,000 mAh power, it's perfect for busy days, trips, emergencies, or anytime your battery drops too low. Grab yours on Amazon through the link in the comments before your phone hits 1%.
Next up, we look at the regulatory tightrope walk in Maine. We break down the impact of the Maine data center moratorium debate, examining how Governor Janet Mills' veto on a statewide ban has sent shockwaves through the construction industry and what this means for future infrastructure projects nationwide. Then we turn to incentives for massive projects. We explore the growing interest in tax breaks for data centers as Minnesota cities weigh in on incentives to lure these megaprojects, and whether local government support can unlock the next wave of technological growth. Finally, get ready for a massive shift in building technology. Trane Technologies Chair and CEO David Regnery is declaring that behind-the-meter power will be universal across all buildings, not just data centers. Don't miss this critical analysis on how Trane is redefining the future of energy and what this means for every structure you see around you. Stay with us. Generac Holdings, GNRC, shares surged by 17.4% following an upward revision of its 2026 outlook, driven primarily by strengthening demand in the data center sector. This development has prompted analysts to reevaluate the stock's investment case, raising questions about whether the bullish narrative surrounding backup power and data center growth has fundamentally changed. The recent Q1 performance beat, coupled with the revised 2026 sales guidance, has bolstered near-term catalysts related to data center orders. However, the report emphasizes that execution risk and the capacity ramp within the data center segment remain the most significant operational variables influencing the stock's trajectory. The April guidance update was key, pushing 2026 net sales growth expectations into the mid to high teens percentage range, while maintaining a net income margin between 8% and 9%. This outlook directly links Generac's performance to commercial and industrial strength, specifically citing data center orders, and connects near-term results to ongoing manufacturing expansions, such as the new Wisconsin facility, designed to support large generator demand. Despite the optimism surrounding data centers, investors are cautioned to remain mindful of underlying structural challenges. Generac projects $5.5 billion in revenue and $593.3 million in earnings by 2028. Furthermore, while some lower-ranked analysts previously expressed caution, projecting lower revenue figures for 2029, the new data center-driven guidance may temper those pessimistic views, or conversely, serve as a stark reminder of structural threats posed by grid reliability issues and regulatory pressures. Generac operates globally, designing, manufacturing, and distributing energy technology products and solutions. The company maintains a strong balance sheet and reasonable growth potential. The analysis suggests that the stock may be worth up to 16% more than its current price based on certain fair value estimates, encouraging investors to weigh the evolving demand landscape against execution risks. An effort to curb large-scale data center construction in Maine has offered critical insights into how regulatory uncertainty can reshape the national construction industry. Maine Governor Janet Mills vetoed a bill on April 24 that proposed a statewide ban on data centers exceeding 20 megawatts for over a year. Lawmakers ultimately failed to override the veto, halting what could have been the first statewide moratorium on data center development in the United States. The halted project, a $550 million redevelopment of a former mill site, was projected by state officials to generate over 800 construction jobs and boost local tax revenue. Industry experts warn that a statewide ban would have immediate and significant repercussions for contractors and developers. Kaitlyn DeYoung, a partner at K&L Gates, stated that large data center projects are complex, multi-year undertakings involving extensive site work, substation installation, utility extensions, and long lead electrical procurement. She argued that a statewide pause would disrupt the entire construction pipeline and eliminate the ability for developers and municipalities to negotiate project-specific conditions. DeYoung further explained that a statewide moratorium would fundamentally alter project shaping, removing the local bargaining path even for projects that could meet local expectations with tailored conditions. Instead of eliminating demand, experts suggest such restrictions would likely cause investment to shift to other markets, as developers lacking a clear regulatory path will redeploy capital. The proposed 20-megawatt cap was specifically aimed at the largest and most energy-intensive facilities, particularly those supporting cloud computing and artificial intelligence. John Crossley, also a partner at K&L Gates, noted that this threshold captures most of the activity causing concern. While smaller facilities might proceed under this limit, they would not match the scale or economic impact of larger builds. Crossley cautioned against the misconception that stopping large projects frees up power capacity, emphasizing that grid constraints and power timing remain the primary factors dictating project schedules. Policymakers nationwide are increasingly focusing on infrastructure demands related to data centers, including grid capacity, water usage, and environmental impacts. While Maine's proposal stalled, similar regulatory discussions are gaining momentum in other states. Experts suggest responses will vary, ranging from caps and reporting requirements to new cost allocation rules for infrastructure upgrades. DeYoung concluded that while local pauses can be navigated, a statewide restriction fundamentally changes how the entire market is viewed as developers and construction firms assess opportunities. Minnesota cities are actively considering tax incentives as a strategy to attract major data center projects. Local governments are weighing various financial incentives to lure these large-scale developments into their regions. This move signals a growing competitive landscape as technology companies seek optimal locations for their expanding data infrastructure. The decision-making process involves careful consideration of the economic impact, potential job creation, and the long-term fiscal benefits these megaprojects could bring to the municipalities. Trane Technologies CEO David Rignuri announced a bold vision for the future of commercial real estate, asserting that behind-the-meter power systems will become a universal standard across all building types. Speaking during the company's first-quarter earnings call, Rignuri stated, "We have a philosophy that it will happen in all buildings." He emphasized that the need for on-site energy generation extends beyond data centers, predicting that all buildings will become smarter and more resilient as a response to energy waste, which Trane estimates amounts to about 30% of paid energy. While data centers continue to drive demand for advanced cooling and energy solutions, Trane anticipates broad adoption across sectors including higher education, healthcare, and government facilities. This strategic shift is a key component of the company's future growth projections. Financially, Trane reported $5 billion in revenue for the first quarter of 2026, bolstered by robust performance in its Americas commercial HVAC segment. Applied commercial HVAC bookings in the region surged by over 160%, and enterprise organic bookings rose nearly 70%, with the segment backlog increasing by 40%, signaling sustained demand. Rignuri highlighted the strong execution within this market, noting that the Americas commercial HVAC business is significantly outperforming end markets. Data centers remain a primary growth driver due to operators prioritizing reliability, which necessitates advanced cooling and integrated service contracts. To capitalize on this, Trane is expanding its capabilities through strategic acquisitions, most recently including the purchase of Stellar Energy Americas, which specializes in modular chiller systems for data centers. Rignuri suggested that these modular systems could help alleviate skilled labor shortages by simplifying installation complexity across all verticals. Furthermore, Trane leverages its domestic manufacturing footprint, including 20 US-based facilities, as a competitive advantage to manage supply chain volatility, tariffs, and material cost fluctuations. The CEO expressed confidence that localized manufacturing will help mitigate inflationary pressures. Despite anticipated raw material cost increases, Trane does not foresee significant changes to its pricing strategy in 2026. Looking forward, Trane is actively collaborating with hyperscalers and semiconductor companies to develop next-generation cooling systems tailored for evolving data center technologies. The overarching message remains clear. As the demand for energy efficiency and resilience escalates, behind-the-meter power and intelligent building technologies are set to become standard features in the built environment.